The market exposes every weakness you refuse to fix. Fear, greed, hesitation, ego, self-sabotage. These 12 rules are how you take your power back. Far too many traders become attached to the outcome of each individual trade. They use the market as their scapegoat to get their desires, to have their ego pleased in that moment. For example, so many traders use the market to attain a trader's sense of freedom and escape from their own pains and their own sufferings and their financial situation or in their 9 to 5 job. They use the market as a way to get easy money to be able to escape their own pains, for example. But any trader who has attempted to be right on every individual trade and take something from the market for their own satisfaction or for their own benefit, for their own agenda, knows how that ends up. It ends up in them eventually being humbled by the market significantly. If you think deeply enough about it, the market has millions, if not billions, of factors influencing the price of it at any point in time. Nobody knows what all those factors are. The price of any given asset is dependent on supply and demand at any point in time. The amount of factors influencing the supply and demand of any given asset is significant. Yet we as traders come to the market saying, I want this trade to do this and give me this amount of money so I can pay my rent, I can pay my bills, I can get this status, I can get this recognition. Far too many traders exaggerate their own ability, puff themselves up in a state of pride, thinking they can take something from the market that the market's not willing to give to them. Now, as a trader, you can have everything you want, but not right now. You need to embody probabilistic thinking and let your edge play out over a larger sample space to eventually approximate profitability from the market. You see, to predict an individual outcome and to be right on every individual trade is unrealistic as a trader. It's impossible as a trader. But you can identify an edge based on previous data, and you can put that edge into a mechanical trading system and execute that edge over 100, if not 1,000 trades, and eventually you'll approximate your end of year return or your edge at some point in time. Now, that doesn't mean every individual trade is going to be a win. You're going to have to embrace both wins and losses and stick to your trading plan in order to attain your true edge. But the first rule to master your trading psychology is you have to embody this probabilistic thinking. Any trader who tries to take from the market in every individual trade eventually gets humbled. The trader who embraces both losses and wins in pursuit of their trading edge and relentlessly executes that over a large sample space is the one who's eventually rewarded. But in order to do that, you have to embrace probabilistic thinking. So what you want to do as a trader is you either want to study or learn an edge or develop an edge based on market observation and get clear on a specific entry, the way you enter into the market. What specific criteria do you need to see in the market for you to enter? You then want to set a specific exit. What specific criteria do you need to see in the market to exit? And then you want to develop good risk management that allows you to come to the market and execute for 100 trades, if not 1,000 trades, embracing both wins and losses. You have to manage your risk well enough to be able to embrace the losses that are necessary to consistently stick to your trading plan in order to reap that end of edge reward. So if you have a strike rate of 60% and you are taking 1,000 trades, you have to know and understand that 40% of those trades are going to be losses. So what is your risk management in order to stick through those 1,000 trades and those 400 losses in order to get to that end sample space so you can approximate your edge? You see, far too many traders are risking too much. They've got too much on the line on the individual trade because of their own greed and because of their own ego and because that they want that money quickly and now. And these are the traders who end up going boom and bust. They get humbled eventually from the market. So you want to get clear on your entry, your exit, your risk management. You want to test these and put them into a mechanical, replicable trading plan that you've tested and you know is profitable based on previous trading data. Then in order to show up to the market and replicate this edge over a large enough sample space, you need to be able to put your edge into a mechanical trading plan. This mechanical trading plan outlines what specifically you need to see for your entry to be able to take an entry. And then what specifically you need to see to be able to get out of that trade with either a win, a loss, or a break even. And further than that, you want to take your trading plan and put it into a specific checklist. So you got a step-by-step process that you can follow, a protocol. When in an overwhelming market where you could be making millions of different decisions, you've got your checklist that guides you to the process-based decisions that if you replicate over 1,000 trades, you know you'll approximate your edge. And then you want to make sure you're abiding by strict risk management protocols, meaning you're never risking more than 1% of your total account size on any given individual trade. And some traders choose to start with less and risk less. And you want to make sure you're never breaking this rule, because if you're risking more than 1% on any given individual trade, then most likely you're being influenced by greed. Most likely you're being influenced by this desire to take money from the market quickly. And again, those traders are the ones who get humbled the quickest. Unless you have data to prove that your strike rate is good enough and your win rate is good enough, always risk less than 1%. You also want to install a daily loss rule. So if you exceed a certain amount of losses for the day, you stop trading. You want to also have an exposure rule. How many positions you have open in terms of exposure, so you're not over leveraged in your broker, and to ensure that you don't break the daily loss limit. You also want to make sure you have a max drawdown for your account. If you're trading prop firms, this is already established. If you're trading your own personal capital, you want to make sure you have some sort of a drawdown, because you want to think of your trading as a business and as an investor. You don't want to be thinking from your, your trading account from a gambling perspective where you're willing to lose all your money. No, you're willing to lose a portion of your money in pursuit of your edge to have a potential reward. That's how a business-minded trader approach would approach the market. So you want to have some sort of a max drawdown, even if it's your own personal accounts. And then you want to focus on aiming to, at the end of the largest sample space per annum, per year, not exceeding more than a 10% drawdown at any point in time, but trying to exceed 25% returns per annum. If you have a drawdown, a max drawdown to return ratio of 10 to 25, you're doing exceptionally well as a trader. Then to tie rule one together, in order to never blow a funded account, in order to never blow your own personal accounts, in order to have a sustainable path to scaling to 7 figures in capital, you want to make sure you implement some sort of a drawdown protocol where if you go deeper into drawdown, this is break even here, the deeper you go into drawdown, you scale your risk down. So let's say, for example, you're trading a $100,000 account and you're starting to risk 0.5% when you're at break even. When you go above 3%, you can up your risk to 1% per trade. But right now you're risking $500 per trade on a $100,000 account. If you go 5% into drawdown and your account drops below $95,000, you then want to half your risk. So you've limited the amount of risk the deeper you go into drawdown. The reason this is the case is because you want to do everything you can to protect your psychology to ensure that you're staying process-based. From my own analysis of traders and working with so many of them, I find that traders, the deeper they go into drawdown, the more emotional they get, the more fear and greed is promoted in their trading. So what I find is that more traders who go into drawdown end up blowing up their accounts because of fear and greed than they do sticking to their edge and working their way out of drawdown. So you want to do what you can to protect your psychology so that you can stick to your trading plan. The best way to do that is to minimize the amount of risk and lower your risk. Now, rule number 2 to master your trading psychology is you want to start to understand how your mind operates as a sort of an operating system, and how you interpret information and the certain state you're involved in that moment, whether it's a state of elation or more of a depressed state, is going to influence the decisions you take. For example, if you're in more of a elated, proud state, you're more likely to react in order to seek pleasure. And you're more likely to minimize risk in the market and take more risk on. And if you're in more of a depressed, fearful state, you're going to react in order to avoid pain. And you're going to potentially exaggerate the risk in the market and be more risk averse with your trading. Now, in both these states, you deviate from your edge. It's only when you have a balanced mind, neither elated nor depressed, that you can interpret the market clearly and make a decision based on your trading edge and trading plan. So rule 2 of trading psychology is we need to do what we can to balance your state out so that you can make wise, objective decisions according to your trading plan that you just developed. So how do we do that? We want to develop some sort of a protocol to clear your lens so you can objectively stick to your trading plan. And this is quite a good protocol that I've developed over years of trading myself and working with many traders and having many traders come into Telos, my prop firm, to ensure that these traders stay balanced and stick to their trading plan. And those that implement this prime to perform protocol tend to do quite good. And it's about priming your psychology to understand what your trading plan says, developing your daily watch list, getting organized, and preparing for your trading opportunities. I find a lot of traders that jump onto the charts and make impulsive decisions to trades they haven't planned for, they're more likely to make emotional decisions to that. So if you're planned and prepared your watch list and your opportunities for that day, you significantly lower the chances of making emotional decisions out of the amygdala, and you increase the probability of making decisions out of the prefrontal cortex, more strategic decisions. Now, 15 minutes before your session, you want to do some sort of balanced breathing and guided meditation to ensure that the state you're in is a little bit more present, a little bit more balanced. And then prior to every trading decision, you want to be implementing the free Bulletproof Your Trading Mindset Tool 2.0. If you don't already have that, make sure you download it in the description. It's completely free. And that tool is going to help you identify and ground any expectations or ideas that you're projecting into the trade that aren't rooted in truth, just your own imagination and fantasy that you're projecting into the market, which ultimately leads to making that trading session more emotional for you when it doesn't need to be. So you want to implement the Bulletproof Your Trading Mindset tool before every trade. And you also want to do the visualization exercise, which is you visualizing the outcome, both being a win and a loss, and you being unfazed by the outcome on that individual trade. Because remember, it's not about the outcome of that individual trade. It's about priming your psychology to realize that the outcome of that individual trade could be a win or it could be a loss, but either outcome doesn't matter. You're unfazed. What matters most is sticking to your trading plan and your edge on that individual trade. And this prime to perform protocol just helps ensure you do that. The Bulletproof Your Trading Mindset 2.0 tool is a gold mine in ensuring you that you go into that trade sticking to your trading plan, not making decisions based on what you think is going to happen, but making decisions based on what your trading plan says and based on what's been presented to you in front of you by the market. Now, rule 3 of trading psychology is you want to continue to challenge yourself as a trader and continue to scale up, because otherwise you're going to get complacent. You're going to stop doing what got you there in the first place, and you're going to eventually wither out. So you want to start by hitting a 6-figure funded account. And then once you've acquired that, go for multiple 6-figure funded accounts to get to 7 figures in funding. Then once in that, you want to focus on getting 6 figures in payouts. Then 7-figure or 6-figure personal account based on those payouts, and then private investment, then looking at institutional investment as well. So you want to continue to set greater and grander challenges for yourself so you have continued motivation and reason to do the work that got you in there in the first place and continue to grow. Now, if you do those first few rules, you have a mechanical edge, you ensure your mindset is poised before you trade, and you continue to focus on leveling up the amount of capital you trade and the funding you take on, you're going to make more and more money from your trading. And you're going to make more money than what you know what to do with it. So what's important is you have some sort of a money management system. Otherwise, the more money you make, you're just going to blow. So as your income increases, you want to have some sort of a system that allows you to save a portion of it, put a portion aside, put a portion aside, and then once you have a decent cash cushion and savings, you want to then force that income into investments. Long-term income producing assets that you don't touch, and you just let them compound. And you want to focus on increasing this so you have continued accountability to making more money. And then all you do is as income comes in, you save a portion, you invest it, let this grow, let this grow, let this grow, let the dividends compound and compound and compound and take advantage of compound interest. And the more you hold yourself accountable to put into investments, the more funding you're taking on, and you're just keeping this cycle going and going and going and going. And that way you never get complacent. Rule 5 is you want to ensure that you have goals in all areas of life. Any area of your life that is left disempowered is going to impact your trading. For example, if you have a lot of arguments in your family and your relationships, that's going to impact your ability to show up focused and trade successfully. Or let's say, for example, you don't take care of your health, then you're going to have some issues in that. They're going to be distractions from your trading. And you want to make sure that you holistically pay attention to your life. You have your trading, which you're going to grow. Your personal finance is going to grow as a result. You want to focus on figuring out what's the highest priority action step I can do with my health and fitness and prioritize that. Maybe it's just going for a walk for 20 minutes a day. Then who are the individuals I'm most inspired to spend time with? Who do I classify as my family? And then dedicating time to doing things that you love to do with them in those environments. Same with your mentor. What information do you love to put in your mind and prioritizing that? Who do you love to socialize with in terms of your friends and prioritizing that? What's your spiritual mission? What's the reason why you're building your trading and your finances? What's the meaning behind that or some sort of a cause that's very meaningful to you that you can have some level of extra motivation and drive towards? And holistically paying attention to all areas of life, because any area you leave disempowered is going to be a distraction. You're going to be overpowered in that area, and it's also going to be a distraction to your trading. It's going to impact your ability to show up as a trader. And then once you have clear goals in each area of life, then you want to take those goals and chunk them down into high priority action steps that you can focus on daily. The amount of traders that I've worked with that overtrade because they're bored, they've got nothing else to do. That simple exercise of setting goals in other areas of life and then high priority actions and then scheduling an inspiring day or a perfect day for them will help alleviate that. Because instead of overtrading, you now have something else that's equally as inspiring for you that you can go off and do, and you feel like you're being a contribution and you're feeling like you're moving towards your goals. That is meaningful, and that oftentimes alleviates overtrading out of boredom. And then now that you have the proper processes and you're starting to scale up and your life is organized and you've taken care of all areas of life, you then want to identify what self-sabotaging or so-called self-sabotaging and destructive behaviors you still participate in, and understand that these self-sabotaging behaviors are coping mechanisms for certain states you don't want to be in. You see, what happens is, as a trader, we're triggered by a certain trading loss or a missed position. We get put into a state of anxiety, a feeling like we're on the back foot, feeling like we're in drawdown. And then this so-called self-sabotaging behavior, like overtrading, taking trades outside of our plan, is our last-ditch effort to alleviate this state. And then we beat ourselves up with guilt. And because we're holding and harboring guilt around that particular action, we're unaware of how it serves us, the unconscious motive, and we repeat the behavior when we're triggered again. So what you do is you go back to the times you're participating in a self-sabotaging behavior, figuring out in that moment when you're participating in the behavior, what state are you trying to alleviate? And then what triggered you into that state? And then identifying action steps that allow you to dissolve the triggers, like the Bulletproof Your Trading Mindset 2.0 tool, and then implementing viable alternative action steps that you can utilize to alleviate the unwanted state that don't involve doing the self-sabotaging behavior, to help dissolve the triggers and manage the state without overtrading or deviating from your trading plan. That's how you resolve self-sabotage. And then rule 8 is about embracing both sides of the market. The amount of traders that live in this fantasy land that they're going to be able to win without lose and take all these wins and have profitability without taking losses and having unprofitability at times. Trading and consistent profitability encompasses both winning and losing. It's a sample space. You need to be able to embrace the loss in order to have consistent profitability. And you need to be able to manage the win to have consistent profitability as well. Because some traders don't know how to manage winning. Some traders don't know how to manage losing. Some traders don't know how to manage both, and they oscillate and they never achieve consistent profitability. In order to have consistent profitability, you have to dispassionately embrace both winning and losing. And the truth is, in order to continue to grow as a trader, you need both loss and win. Because if you have win without loss, which you can't, but if you did, you would lead to, complacency and stagnation. This is why it's important to continue to focus on scaling up, because you want that next challenge, you want that next degree of negative in order to grow again. Otherwise, if you just stay at the level you're at, you're going to become complacent. And then if you had loss without win, which you'll never get as well, it leads to stagnation as well. The traders who embrace both wins and loss grow maximally. And I know many consistently profitable traders who've completely redefined the way they look at wins and losses. And wins shows them the potential and the opportunity, whereas the losses remind them and keep them grounded, remind them of the risk in the market, remind them of the importance of their trading plan. So they use both as kind of guardrails to keep them, in feedback, to keep them in check, to keep them focused on their trading processes and trading plan, aware of the risks in the market, and they grow maximally. Whereas some traders are so addicted to winning the positive polarity that they can't face the inevitable loss and they spiral. Whereas the best traders use both as guardrails. All right, I took a win. Great. That shows me the opportunity in the market. All right, I took a loss. It's like touching a hot stove. It's a reminder of the risks in the market. It's a reminder of the importance of sticking to my trading plan. It's a reminder of staying grounded and focused. I'm going to use both to stick to my plan to achieve my ultimate consistent profitability that I'd love to achieve. Maximum growth happens in the border of both winning and losing. You need both as a trader. You always continue to get both. Just don't become attached one way, because the more attached you get here, the more you're going to attract painful losses to help you break your addiction to the positive, because you need both. So break out any unrealistic expectations you have on others or yourself to be one-sided. We can go off and say, all right, unconsciously, I have this expectation of myself that I have to be a winner without a loser, up without down, positive without negative, successful without a failure. And we set these one-sided expectations, and then when the other side inevitably appears, we're so disappointed and upset, and we go through all these emotions, these negative emotions. The negative emotions are there because you're holding an unrealistic expectation on yourself to be one-sided. The truth is, you're two-sided, I'm two-sided, the trading experience is two-sided. You're going to both win and lose. I'm going to win and lose. I'm going to be up and down. You're going to be up and down. The market's going to provide you with wins. It's going to provide you with losses. So when we balance out our expectations and we expect ourselves, others, and the market to be two-sided, now we're holding on to realistic expectations. We can go and find how losing serves us at times, and we can find how winning is a drawback to us at times. So we can break our addiction to winning, and we can break our avoidance of losing and embrace both sides to have a realistic expectation on the journey, which is it's going to be two-sided. And that's ultimately when we're embracing both sides of the journey, is when we stick to our plan and we can have consistent profitability. Rule 9 is now we have to go in there and reshape our beliefs. Any one-sided beliefs that we're carrying in our mind about money, for example, money is always good, never bad, always helping, never taking away. Money is always, saving, never harming. Then these are one-sided beliefs that lead us to become infatuated with money, fear the loss of it, fear missing out on it, and now we're run by money because we're run out of the fear of missing out of it and fear in losing it. So money runs us. Or if we think money is never good, it's always evil. Or we think money is never helpful, it's always harmful. Or money is the root of all evil, or whatever beliefs you hold about money, we're going to try and avoid it, and we're going to try and squander it unconsciously a lot of the times. So you want to identify any lopsided beliefs you have around money being bad or good and find evidence of the opposite. For example, if you're holding this belief that money always helps relationships, you want to find where it's harmed relationships. You can balance that perception out, and you can realize that money is neither good nor bad. It's just a tool to help facilitate fair exchange and clear the beliefs that we impose onto money, because money is separate from our own perception of money. And it's about balancing out our perception so we can see money for what it truly is. Then rule 10 of trading psychology is you want to go back through our past and identify what moments, money or other related, we're holding and harboring guilt. Because any accumulation of guilt where we feel like we've let ourselves or other people down leads to lower self-worth and leads us to altruistically squandering the money. We don't feel worthy of achieving our goals, or the moment we make money, we find a way to squander it and get rid of it. And we don't feel worthy of holding on to things. And it accumulates. An accumulation of guilt leads to low self-worth and then a squandering. So we want to identify any times in the past where you perceive to have hurt yourself or other people, and identify those guilts and understand you have to clear those and address those. Otherwise, holding on to that is going to lead to you squandering money and not feeling worthy of achieving your goals. And then rule 11 of trading psychology is we need to identify the individuals, the mentors we have as heroes, we put up on a pedestal, and we're exaggerating their ability. And in turn, because we've got them way up on a pedestal, we're minimizing ourselves and we're beating ourselves up because we think we're not like our mentor. And we need to identify And we need to take these individuals off the pedestal. Otherwise, we're going to continuously inject into our own trading decisions what we think we should do. And we're going to continue to beat ourselves up for the actions we take because we're not like our mentor, for example. But what's wise, instead of putting them up on a pedestal, is learn from them, learn their strategy, and take a step back and then figure out, all right, what components am I going to integrate that work with me, my personality, my risk appetite? And instead of putting them up on a pedestal thinking they're a god, you now stand on their shoulders and you use what they've taught you as a platform, and you go and test and study it yourself to create your own trading plan, your own rules based on what you've learned, what serves and works for you with your risk appetite, with your time zones, with your lifestyle. And now you've wisely learned from someone that has knowledge, as opposed to putting them up on a pedestal, minimizing yourself, and then beating yourself up because you're not like them. And then rule 12 of trading psychology is you have to understand the significance of the subconscious mind and the accumulation of past charges that are logged in the subconscious mind, both good and bad, win and loss. And it could be through sport, it could be through previous trading experiences, it could be through your own perception of yourself, childhood, work with your siblings, mentors, previous relationships. What happens is we log an accumulation of charges in the subconscious mind, infatuations and resentments. And these past charges influence how we perceive the market and how we interact in the market. If you don't address your subconscious mind, it's going to influence your perceptions, your decisions, and actions in the future. And we're not going to be able to stick to our trading plan because we're going to constantly be trying to seek after a pleasurable win and avoiding a painful loss, because that's how the subconscious mind is programmed, as opposed to managing the noise in the mind and then sticking to your trading plan based on what the market communicates at that point in time. So self-mastery and mindset mastery is no different to trading mastery, because really what the market is, it's a mirror of your own subconscious mind. If you have unaddressed charges, the mirror is just going to reflect back onto you. Whereas if you address a lot of the charges in the subconscious mind, you can come to the market with a clear state of consciousness and a clear mind and trade based on your plan and execute in the market. Traders, these are the 12 rules of trading psychology. And you want to take on board these insights and use them to have more self-awareness on how your mindset and your psychology impacts you and stops you from having consistent profitability. And if you found this useful, I want you to like and subscribe and comment below your main takeaway. Now, before you click away, I want you to jump onto this video that's going to show up on your screen and watch it through. It's a 10 to 15 minute video where I show you how to master your trading psychology.